not only in and of itself a horrible thing, but the way we attempted to compensate for it ruined what could have been a far better counterfactual. So I'm going to do three things. Firstly, I'm going to describe to you what this counterfactual would look like. Secondly, I want to talk to you about why this discourages bad behavior as the alternative on our side. Thirdly, I want to talk to you about trust and politics. And then lastly, I'll do a bit of preemption about regulations and why most of the regulations they talk about will be ineffective or have been ineffective. So firstly, then, what do we think the counterfactual would look like? The first thing to note here is that we would go after bankers and banks that committed fraud, broke our financial laws, and pursue them to the full extent of the law. That is to say, in the most extreme cases, this would mean locking up bankers who defrauded their investors by privately betting against their positions or misleading investors about the quality of collateralized debt obligations, CDOs, right? In most cases, this would look like applying lifetime bans on fund managers and bankers who committed gross negligence or waited out selling toxic assets until their own positions were secure. But secondly, and more importantly, right, bank bailouts will still have happened on our side as needed. However, the leverage from these bailouts is used in exchange for cooperation with authorities to punish backed actors instead of changing the specific policies that have happened in the status quo. That is to say, we will keep individuals accountable that commit fraud, and we will continue to do so. Note that further that these bailouts were paid back with interest, so that this would also happen as well on our side of the house, so there won't be any money lost in the system. The importance of this part of our counterfactual is that we think that this leverage can be used to force banks into giving information in complete transparency to the SEC and the government about the internal processes of these banks, what went wrong in the chain of command, how people were allowed to take such egregious risks, etc., thus preventing future instances of the same things happening in the counterfactual. The last thing that I just want to point out is that their side in this debate needs to defend the specific financial regulations that we got after the financial crisis and why they are comparatively better than any of the systems that we think would have alternatively arisen on our side. Firstly, then, why does this discourage bad behavior? The first thing to note here is that the root cause of this crisis was fraud and malfeasance in the financial system. That is to say, extreme complexity of the system meant that hedge funds, shadow banks, and even major financial institutions have always had the best information and can use that to get the best returns from themselves. Comparatively, most people, even some experienced investors, do not know what a super CDO is or how extremely complex second-order financial derivatives actually are. It is probably true then that bad mortgages would have happened for structural reasons on either side of the house, since the US government had made it very easy to get mortgages in the 1990s and the 2000s. However, the difference is these bad mortgages added up to a massive financial risk because of the misinformation and fraud by rating agencies and banks that ensured that investors were not aware of the huge risks they were taking when buying up collateralized loans and could not sufficiently hedge these risks, endangering a huge amount of capital in the economy and putting the country's economy on the brink. Absent this fraud, even with some bad investments, you could not have seen the crisis on the scale nearly as close as what we did in 2008, right? Investors with better information about the risks that they were taking would have had active incentives to hedge against these risks, preventing the banks from ever going underwater and thus limiting the risk to the real economy. This means then that locking up bankers and applying investing bans helps discourage this behavior and prevents future crises in three key ways, right? Firstly, we can show that there are serious consequences to committing fraud for individual investors. Right now, most investors get a slap on the wrist from the SEC, but don't face real consequences, right? They open family offices instead of facing bans. They never go to jail, etc. There are so many ways that they can dodge around fraudulence and get away with it and still continue with their careers. The second thing that we can do is that a huge amount of fact-finding and exposure of information will assist us in the ability for the public and the government to be more aware of the internal failures and processes of financial institutions, which in turn means that we can put tremendous internal and external pressure on these institutions to reform. Finally, note that this creates a stronger chilling effect within financial institutions if people know that there is a risk of criminal sanctions for doing nothing and a higher chance of information being exposed. They are more likely then on our side to whistleblow bad practices and give anonymous tips to the SEC, etc. All in all, individualized consequences make it so that the system is much more likely to avoid fraud and be safe, even though we can still make investments that might be able to benefit the economy, right? Second thing then, why is it that this hurt trust in politics right? I think the context of this argument needs you to understand that the 2008 financial crisis was different in reality to what it was to the public, right? For the vast majority of the public, what they saw was a huge amount of tax dollars being spent on bailing out banks, but very little understanding of why economically this was something that was necessary. But even worse than that was the individuals that they interacted with who were like defrauding them and getting away with making billions upon billions of dollars were not punished whatsoever, right? The result of this then was a huge visceral reaction that was created by the angry public that materialized in two ways. A, people losing trust in banks because they were seen as unaccountable for the harms that they perpetuate. And B, people losing in the political system's ability to regulate banks because they believed that the mainstream political parties were in bed with big banks and that bankers were lawless thieves that practically got away with financial murder. This led to two key things. Firstly, the rise in populist politics, which notably here, a huge influence in a lot of the key swing states when it comes to populist elections were tipped towards right-wing populism because of the inherent anti-institutionalism within the system. And secondly, that there was a loss in faith in the traditional system, which forced more people to jump into more volatile or dangerous financial alternatives, things like shadow banks that are highly unregulated, the crypto market. This also meant that a lot of people were unwilling to engage in formal systems, right? This is why in areas with like very poor financial education, people are much more willing to take like payday loans from loan sharks rather than engaging in what their formal options might be in the system that tend to be much more low risk and much more like accommodating, right? The last thing that I then want to talk about is why broadly the regulations that we got in the status quo weren't effective. The first thing to point out here is that most people didn't understand them. So they did not fight back when almost all of these regulations were rolled back under the Trump administration due to massive bank lobbying. The second thing to note here is that most of the egregious harms happened outside the major banks and in pseudo institutions like shadow banks, hedge funds, etc. So banks just outsource their bad behavior to these institutions that continue to create the same risk. The point ultimately of our case is the status quo has not changed very effectively. And even the changes that did happen no longer exist in the current moment. The changes that would have alternatively happened in the counterfactual were much more likely going to be persistent and would have led to a much healthier and safer economic system I'm very proud to propose.
Thank you very much to the Prime Minister. We are happy.
In with like Goldman CEO because I did an internship in the research division. You know what? That's right. I was one of the people who caused the 2008 crisis, which is why I have all of the spec on this topic. So first, let's talk about why the regulations that they defend are basically bullshit. And the best thing that they could say in their last speech was that prop trading bad, we ban prop trading, therefore we get rid of one bad thing. If we win this argument, there is no op case, right? We're still bailing out the banks on either side of the house. We get additional leverage on our side, and maybe we just win on the principle that jailing a bad person is a good thing, but they need to actually win that the regulations that they get were effectual. And I think that there's a meaningful contingent of people in the economics discipline who say that these regulations actually didn't work. And so making these arguments is a sufficient condition for opening government to win. Then secondly, I'm going to explain to you why our material about dissuading bad behavior combined with the correct assessment of the real causes of the crisis. And secondly, the populism argument that literally gets 5 seconds of glib response that it's an American argument are sufficient for us to win this debate handily over opening opposition and what you might hear from CO. Firstly, the regulations did not work. Let's talk about what regulations we meaningfully saw. The two big changes that we saw were firstly, the ban on proprietary trading, and secondly, capital requirements for financial institutions. There were very small technocratic things beyond that, but these are the main things that we want to talk about. If CO knows more, challenge them to bring it up. So firstly, in terms of proprietary trading, this is when a major bank essentially goes and makes investments in the way that a hedge fund does with your money. They say we ban this, and this is a very, very good thing. They ignore Brian's responses for why this basically accomplished nothing in the financial system. There's two reasons why. The first reason why is that there was no ban on these institutions just giving their money to other institutions that do proprietary trading, right? So right now, Goldman Sachs has an asset management division that is invested in BlackRock and almost every major hedge fund on the street, and therefore has a direct profitable incentive that is tied to the performance of what is essentially proprietary trading. And the money that they use to do that comes from their equity, and that equity is valued based on the total value of money that is invested in Goldman Sachs, in the same way that the equity of JP Morgan Chase is valued based on how much money is in your bank account at JP Morgan Chase. And so it is essentially the same thing. They don't get to invent new regulations on their side and say that they will be better. They have to defend the shitty regulations that we pursued already. The second major problem, though, is that the problems themselves don't actually exist in the banks, right? we explained to you that banks are already heavily regulated financial institutions on either side of the house, before and after the crisis. The real problem are shadow banks, institutions that take people's money and play around with them, but aren't treated essentially as banks because the people whose money they have are not officially people who are depositing money in a CD. When I put my money, for example, into Robinhood and I have $5,000 just sitting out that isn't actually invested in Apple stock, it's essentially being treated as a bank account for me, but Robinhood isn't regulated as a bank, right? And there are institutions like BlackRock that are worth literally $10 trillion in assets under management. That is several times the valuation of the biggest bank in the United States that are completely unaffected by the regulations that they want to talk about. And these institutions probably just got the loss of investment that left the banking system and moved into the shadow banking system. So there really was no change. The importance of this argument is as follows. You're never going to be able to stop the financial industry from coming up with new loopholes or new versions of the same thing that has more complicated terms and takes 5 years for the SEC to cap up with, right? The Volcker rule is 1,500 pages long and is riddled with loopholes that nobody understands and nobody is aware of. The real problem is getting investors to hedge their risks appropriately. Even if they do risky things with borrowed money, if they hedge against those risks, that means that if their investment fails, doesn't mean that your money gets lit on fire, then at least we have some kind of insurance against this happening. And the reason why investors can't properly hedge their risks right now is because those risks are not disclosed to them, because there's fraudulent behavior at the top level of the financial system that refuses to disclose those risks because they make more money when they can misprice things higher, not disclosing those risks. That is the reason why a financial crisis turns into an economic crisis. That is the reason why the homeowners never got their homes back, because those risks were not appropriately hedged. The other thing they want is capital requirements. Really quickly on this, A, the Trump administration rolled it back. B, the capital requirements that we did have basically don't matter because interest rates are zero, and so a bank can just borrow money from the Fed at a zero interest rate if they have a capital shortfall. So having capital in hand basically changes nothing because there's no real cost to them. And if there was, it's like a 0.25% interest rate. Okay, our arguments. Firstly, we did punish individuals, but we punished one individual, and it was a low-level banker at Lehman Brothers that was essentially like a tokenistic victory at the very beginning of the Bush administration's response to the crisis. That is not the same thing as systematically going after people like Lloyd Blankfein, who testified on the Senate floor that the bank doesn't have a fiduciary responsibility to the investors that make 100% of his salary every single year. That is not the same as bailing out AIG, which actively defrauded its investors and the public. There being huge public demonstrations in New York City and Washington, D.C., and doing nothing about the CEO, who is very obviously responsible for a huge chunk of the crisis, right? The public is obviously aware that the bankers got off scot-free. The average banker is also aware that the small dude at Lehman Brothers who took the fall was just a fall guy, right? He wasn't the real person or the thousands of people who were responsible for the systematic fraud that allowed this to happen. The glib response that one person solves is simply not enough. What were the mechanisms we gave you? We told you, firstly, that by jailing more bankers than just one and by applying lifetime investment bans to many other, you take away the positive incentive to commit fraud, which is that you make more money on their side, right? They say you'll still commit fraud because you make money by committing fraud. Yes, but then if you get banned for life or you go to jail, that money goes away. That's exactly the reason why we create a countervailing incentive. Please be comparative. We also explained to you why, independent of all of that, we do a huge amount of fact finding and create a chilling effect within banks. And this argument is largely unexplored by opposition, right? When the SEC can requisition huge amounts of information from these financial institutions, it means that the media, the public, and the government has better knowledge of what goes wrong in these banks and how to regulate them effectively so that these things don't happen. It means that the existing regulations that we have, even prior to what we did in 2008, are at least more easily enforced when we understand what is happening in the banks and when there are people who are working under the most corrupt ones that are willing to come forward. You couldn't ask a POI at 558. So that also makes it more likely that we expose these people for the most egregious kinds of circumstances. They say that, well, these people didn't have options. Okay, fine. We're not going to punish low-level analysts who didn't have options. We are going to punish CEOs and executives who did have options. And the analysts are more likely to go to the Sarbanes-Oxley Act and get whistleblower protection if they know that their CEO or their manager is doing something very bad. Second argument that we cleanly win is populism. 2 points under this that I think are very cleanly winning. The first one is that even if the financial crisis was one of many causes of Trump's rise, it was certainly a big one, right? A huge amount of people losing faith in the public institutions and the establishment moving to one side, even if it's a subset of them, is probably enough to explain many of the political problems we have right now. Like, Trump won these states by 0.5% margins. If 1% of people were convinced by this specific issue, that's a huge fucking deal. And that led to the rollback of all of the regulations they want to talk about. Whether or not this caused it, they still don't have a case at the end of the day. Secondly, though, specifically with financial institutions, what Brian said is that this is what causing a mass exodus of trillions of dollars out of the banking system and into completely unregulated systems like like cryptocurrency and decentralized finance that have zero regulatory control. So even if they win that regulation is good, you just don't get regulation when people won't participate in the regulated systems, which probably preempts a better version of the op case that you might hear in CO. We're very proud to propose.
Thank you very much to the DPM, and it's time for DLO to close the front half of this debate.
Cool. Can you hear me?
Yes, all good.
Yeah. Cool. As always, this is for the Mexican debate circuit. Yeah, North America. And I will start in 3, 2, 1. At the top, and just to be extremely clear, because I didn't do that internship, I want to note the 2 mistakes that government makes. The first is they basically dropped the at best, all of their explanations, which might be perfectly right, mitigate most of the impacts that Ricky gave to you. They don't explain why, other than that particular mechanism, out of the 4 that he gave you, this wasn't enough. And it still doesn't prove that it didn't have net benefits for the 7 to 8 years that it was in effect from 2014 to 2021. Panel, I think anytime someone says Trump took it down, it probably worked for a while against those who had interests at the top. I want to be extremely clear about their argument on populism and give you 5 responses. The first thing to note is their whole claim that people didn't trust the regulations and they were super mad at the government is probably misplaced. I think it seems untrue that people were just thought that this bailouts were they were conceptualized in the way that Brian talked about. I think just intuitively, with the people you've talked and heard on TV, the reason people were mad at the bailouts was because people thought the government was bailing out assholes, right? That they were helping the banks that fucked them up in the first place. I think that intuitively tells you, panel, that backlash was in fact coming from other areas, that people weren't stupid enough to not know who fucked them up. They weren't mad with these individuals either way. The deterrence that they talk about happens either way. And I will tell you how this deterrence happened either way. But in most instances, I think the reason people were mad was because the financial structure allowed for it to happen in the first place. And what you have to note is government never tells you where they paint the line. The reason why the financial crisis happened was not just because the JP Morgan and leaders abused the system, but because U.S. senators in the first place didn't administer or put in place the laws that they had been advised by economists years beforehand. And so where do you paint the line? I think there are 2 problems in here. The first thing to note is you have a huge scapegoat to the terrible lawmakers in the United States. What this entails is in the long run, this literally means this was a completely private issue. And you can completely scapegoat, and now these same lawmakers would have been the ones who said, you know what, they were the ones who misused the system, not us who deregulated in the first place. Our laws, on the other hand, makes it even principally responsible for you to go back and retrospectively change the laws and make it impossible, or at least less likely for it to happen, even if it's just mitigatory, as all the economic explanation opening government trying to make happens, right? So the second thing to note is the laws that improve the economy were going to be present either. So what's the worst case scenario regarding their populism argument, right? People are super mad or people don't understand what happens. Either way, Obama bailed out the banks and Bush invested either way. Even if people are mad, I don't see what the margins of their argument are. At worst, people don't accept this. I think the reason people aren't pushing back to Trump taking it out is just because they don't generally understand finance. They're especially not invested in super big times of crisis. So I don't really understand how this works. But most importantly, I just want to note how even if it is true that this only mitigated and they could have done it through other entities such as Robinhood, there still are different areas from which the deterrence can happen. So even if you don't buy any of the things that I've said, why are there other deterrents that happen either way and are probably symmetrical to their case? Therefore, the comparative is this: we might not do a lot, we do a little, but all of the benefits from government are absorbed in opposition. First area, I think social and political backlash was strong. This didn't only look like social media campaigns, but it looked like Occupy Wall Street, which ended with the ousting of many prominent financial leaders from the financial sector. Closing government is going to tell you that we basically didn't take anyone to jail, which might be true, and that they just went to other countries and are living happy lives. But they couldn't monopolize the system as they were. Many of them did lose their jobs and couldn't continue profiting in the positions of power in which they were. But importantly, it also led, Occupy Wall Street, for example, led to a wage rebellion in New York and other prior areas such as Chicago, where, for example, in New York, this led to the minimum wage being raised to $15. But Occupy Wall Street definitely failed in many other ways. So second area from which you stem deterrence. I think that institutions were fined for billions of dollars. The Credit Suisse, Bank of America, JP Morgan all had to pay more than $25 billion in order for them to participate. No, thank you. So at the end of the day, I do think the comparative is all of the populism that they're talking about, the same virtues, the same negative signaling happens when you find them, when you take some of them, and literally with at the fucking argument they gave on like, even if it was just a token, it probably has the same impact. Even if it was only one guy who you took to jail, it's exactly the same argument. It's probably the same narrative in that you're exploiting them, characterizing them as assholes, but also having all of the benefits on our side. Closing.
Large banks like JP Morgan have been able to hire former regulators to break the rules that they themselves wrote, but capital requirements have made small banks without a huge economy of scale unprofitable, leading to more consolidation and more risk.
I will just answer to the first POI, that they could just hire these regulators. Panel, like they have to prove three things on closing. The first is that social response would have like made that not happen. I think this is not true for a couple of reasons. Like just financial ignorance, as simple an argument as it is, like I don't think people have enough of a push. As angry as they might be, they like this probably doesn't equal like the same circumstances. Like there wouldn't have been enough resistance. Secondly, like you can just have regulations for that, and those are more likely to happen when there's like precedent on regulating the financial sector in the first place. Like I think that their side of the house has a lot less social and political, less political capital on regulating the financial system in the first place. So everything has to stem from social backlash or like from social pressure, which is really hard to happen. The third response is basically my third, same link that I'm going to use for deterrence, which is that these institutions were still fucked for massive profiteering, right? Like even when you can like buy the argument, and this is also like a response to the POI, even when you can buy the argument that like they recovered, and of course they will make arguments that like the financial system is still fucked on both sides, this did mean that they didn't either have the legitimacy or the financial means to continuing to perpetuate most of their crimes. I just want to make it clear, like what is a capital requirement, for example? They determine how much money a bank must have proportional to their assets. So it ensured that banks that do not have investments that like can't increase the risks of default, therefore affecting all those who are reliant on this institution. Look, I don't know much about financial systems, but this seems pretty clear. If you don't have enough of these resources to continue with this investment or to trade in the name of your clients, for example, then you can't do it. And that means, therefore, that all of the people who have money in that bank aren't perpetually fucked by the system. Look, panel, the comparative is the following. Even if they managed to prove that people either didn't they weren't completely aware of who the perpetrators were, and therefore didn't support all the policies that happened, that still doesn't prove to you that the opposite would have happened if they would have known. It doesn't mean on government that for them to have known who the bad people were, or for them to have a sense of justice, would have led to more regulations. I think as much regulations as you have, considering lobbying and considering the power that this institution still had, happened. And so insofar as that's the case, our side is by no means perfect, but it did work for 7 years, and that's just the one that opening government talked about. The other 4 regulations that the info slide talks about are the ones that Ricky talked about that they didn't answer to. Insofar as that's the case, proud to vote.
Thank you very much to the top half so far, and it's time for a member of the government to open the closing half of this debate.
All right, please offer PIs exclusively in the chat. The top half of this debate has the exact same problem as an overregulated financial sector: too much on recessions and not enough on growth. On closing government, we think that the marginal deterrence on future financial crisis is probably a wash, but what regulations have done is hugely stifle growth and promote consolidation that has massively just created worse markets for everyone. I'm going to be talking about 3 things in this speech. Firstly, why too much regulation has stifled growth. Secondly, why growth matters more than recessions. And finally, on promoting banking consolidation. On to the first thing about how overregulation has stifled growth. This has happened in 2 main ways. The first is that banks have less money. The first reason for this is conceded by opening opposition when they say that there are just higher capital reserve requirements that bank has, meaning that percentage-wise, the amount of money that they are allowed to lend into markets is simply lower. Secondly, though, banks are making less money due to the Volcker rule that has demanded the separation of investment banks with commercial banks. What this means is that the primary way that banks were able to make money via forms of investment is now stripped away from them as a financial opportunity. As an important piece of characterization, banks weren't investing in insanely risky things like cryptocurrencies and really risky futures because they also have a self-interest incentive not to go under. Rather, they were just investing in things like growth stocks to a large extent that they're now precluded from doing that generated a lot more return from banks and just things that they're getting back like interest payments. What this then means is that the pool of money that banks have to lend out is substantially lower. The reason why this is harmful is that fewer actors in the financial system get money, which they then use in other ways in order to stimulate the economy that has a really positive impact via the money multiplier effect. So to illustrate this, if I get money as a small business. I then use the money that I have to hire more people. My employees have less money, meaning that they can then use that money to help support other businesses in the economy. So even like 10% more money being lent out into the economy end up having a large cumulative impact in terms of what that money can actually do in terms of supporting people's quality of life. The conflicting kind of response we get from OO is, aha, but banks need a lot of capital reserves because if there are recessions, you don't need things like runs. Firstly, I just don't think that larger capital reserves are actually going to stop runs because consumer panic is really irrational. Like even if on like your spreadsheet, you have an extra 10% of reserves, when what people are thinking is, oh my gosh, I'm going to lose all of my savings if I don't go to the bank, they're probably going to do that anyways. But secondly, even if the capital requirements you have in reserves are lower, so maybe like you have 5% reserves instead of 15%, by investing more money and generating more returns, the net pie that you have is substantially larger. So banks having an extra 50% of money actually mean that the net money in reserves is still going to be higher. The second mechanism in this argument is that banks have become a lot more stringent in terms of who is able to access forms of credit and get money. A lot of regulations enacted with the goal of decreasing risk have had the inadvertent impact of locking out the needy from financial systems. These are individuals who want to access mortgages but don't have collateral and have less established financial history, who often disproportionately come from poor and minority communities. Smaller businesses who have less of a credit history, even though they have absolutely fantastic ideas. Making it more restrictive in terms of who gets loans is bad for two reasons. Firstly, just the quality of life of individuals. Like poor individuals who desperately need a loan in order to start a small business or need a mortgage in order to literally buy property, to have a stable location in order to get things like a job. It's also really good for markets as our second impact in order to just have more smaller businesses entering markets with newer ideas. I think a lot of the problem with like monopolies and larger corporations that they don't have a massive incentive to innovate because they already have a large degree of market capture, so they do not need to do that out of any kind of economic necessity. Smaller businesses who are pitching to a bank that they need a loan often have a niche idea that is really valuable in terms of bringing people services to improve their quality of life, like cheaper technological manufacturing when it comes to things like electric cars. Before I continue, I'll take a POI from opening opposition.
Because the bailouts and like regulations are symmetrical in the debate, where do you think they're more accepted? In the world where the government like bailouts and then regulates from prevention, or where it bailouts and just like punishes without further regulation?
Not gonna lie, that really flew over my head. Like, I don't think that it's symmetric in terms of the degree of regulation. I think you get way more regulation on your side as you concede. I think it's sometimes enforced, it's asymmetrically enforced, but when it is enforced, it creates harmful impacts. If operative safety there has been a lot of growth, firstly, this growth has been less evenly distributed throughout the financial system because fewer poor people are getting loans. Secondly, it's just not sustainable. There's always some kind of bounce back after recession. It's likely to flip back in the future. Second contribution, why does growth matter more than recessions? Number one, most recessions are caused by extraneous factors. It's not like, oh my God, did a bank or CEO take more risk? Things like energy shocks that occurred at the end of the 20th century where oil prices skyrocketed, the COVID pandemic, war and instability within the global economy. 95% of the time, things that cause recessions are symmetric, and therefore the growth is more important frame. Secondly, growth helps us absorb the blows of what recessions ultimately are. So if people have more savings and there's eventual unemployment, it's less likely to negatively impact their quality of life and less likely to have bank runs when people are less panicked because they have higher degree of savings that end up still existing. Things like businesses having more money within their capital buffers are less likely to go under in the event of a recession, decreasing things like systematic risk that exist in markets. Thirdly, there are separate tools to help people deal with recession. So there's things like automatic stabilizers, quantitative easing, lowering taxes, where there just aren't really symmetric tools to help deal with growth. Final contribution, let's talk about banking consolidation. Regulations place a far more onerous burden on smaller banks and larger banks. This is for two reasons. Firstly, regulations are expensive to enforce, both in terms of having like legal expertise and the accountants to actually deal with that, but it also just costs money for the mechanisms that I gave you within my first argument. So when banks are reliant on like investing and can't do that, you end up losing a degree of money. The differentiating factor is larger banks are more financially stable in the first place, meaning that the amount of capital reserves that they have is larger, so they are more able to absorb the economic cost in terms of what that capital loss is going to look like for them. Secondly, larger banks just have a larger degree of lobbying power because they have more money in their budgets to be able to like do that. So they're more able to evade regulations by paying off regulators than smaller banks who need to redesignate that money to actual kind of operations. This has meant a couple things. Firstly, that more small banks directly go under, but secondly, there's more pressures for mergers and acquisitions, and smaller banks are going to be more receptive to offers when their underlying financial position is substantially more volatile. Even if we only stop mergers in one or two cases, this is still really, really important because more consolidated banks also then raise the entrance cost for for new banks in order to enter into the market? Why do we want more banks operating? Firstly, you got things like cheaper and better financial services. When there's more of a monopoly in banking systems, especially within certain communities, there's a massive incentive for individual banks just like jack up prices when you become reliant on certain banks. Whereas under our state of the house, when there's more competition, you have to engage in things like price lowering. But secondly, more consolidated banking worsens risk within financial markets. Firstly, when large banks become too big to fail, there's a larger expectation that they're going to be bailed out, which increases moral hazard. Secondly, individual large banks get more political capture when their lobbying budget becomes asymmetrically larger. But finally, when you only have a couple large banks, you put too much eggs in one basket. If one or two banks end up bypassing regulations and making bad choices, the economy is screwed. When you have multiple small banks operating, interbank lending markets are more robust, meaning that even if one or two banks are doing poorly, other banks can help prop them up. I think in top half, chicken and egg is really unclear when it comes to risk. Is it the CEOs? Is it structural risk? We see that banking is able to bypass this chicken and egg problem by just providing a more clear mechanism of decreasing risk. Very proud to stand in closing government.
Thank you very much for that speech. We are happy to call a member of the opposition to open the case for the closing hope.
Sorry, I'm grabbing my timer. Hi, can you hear me?
Yes, all good.
First of all, just quick pleasantries. Thanks everyone for watching. Thanks judges, thanks CAs, fun tournament, and thanks Michael for working at Morgan Stanley. Our sanction is really simple. We're going to explain, firstly, why the deterrence mechanism of opening government does not work and therefore their entire case fails. Secondly, I'm going to explain why regulatory mechanisms are effective and therefore why all of government cases fail. Okay. First, I want to do some very quick rebuttal. First, they talk about like regulatory rollbacks under Trump. I think this is just factually incorrect. First, we're just not 2008 politics. Rather, we frame the 2008 crisis as a failure of policy, not a failure of individual actors. So we're actually more likely to have the political capital to pass long-term change under our side of the house, create agencies that are actually effective, like having Dodd-Frank rule, which yes, may have been partially repealed, but is still there in some form or another. You know this, Dennis. Their punishment, second though, their punishment is far more short-dated. Punishment, scandals, drama is fleeting. The vast majority of all Wall Street bankers walk away free now. Second thing on populism, people were mad because financial institutions got bailed out. They weren't mad because people weren't in jail. They got mad because huge amounts of money flew to these institutions and they didn't see fundamental change. People don't know about or care about the name of the golden CEO and where he is right now. People know that the poison is the banking system itself. If you replace one shadowy figure with another shadowy figure, it doesn't help these people. They want to know that the system was fixed. Crucially, therefore, their side is worse on populism because the government never admitted fault and is making no ongoing effort. So at the time that Trump is running for re-election, people ask, what is the government doing about the financial system? And the answer is nothing since 2008, 2009. Okay, argument one, they create no deterrent. Look, deterrence is based on the idea that you will actually be prosecuted in the future. I think that this argument doesn't work out for them because they didn't actually make arguments as to why prosecution would be believed to happen in the future. First, I just want to be clear that it's very difficult to prosecute in the future, right? The problems won't play out in the same way. They're not breaking the same rules. They're violating in a different way. They're committing fraud if you're concerned about fraud in a different manner. Crucially, guilt is difficult to assign because the poison in the financial industry is distributed. It's complicated. It's not just a bank. It's multiple wings of the same banks. It's investors. It's rating agencies. It's bankers at different levels. It's in some cases, yes, as they say, shadow banks. And so it's not easy to just track someone down and hold them accountable. To the extent that it is held accountable, it's like some low-level individuals and it's highly resource extensive. The second thing to point out is, again, you won't prosecute in the future. So even if you have capacity, it's technically possible to do so. It's not likely to happen. And so people don't believe that it will happen. Therefore, the deterrence mechanism doesn't apply. A, because the incentive to make prosecution seems final and successful in 2009, 2010 will mean that it will seem like there's not a lot of prosecution that has to happen in the future. Therefore, DAs and other attorneys that are prosecutors don't go after them in the future. Why is this the case? One, because you're seen as having lost to the banks if you make it seem like you have an incomplete job. If you make it seem like we have to keep going after bankers for years and years after this, it seems like you didn't resolve the crisis in the very first place. You as a politician, you as an attorney, you as a prosecutor have failed your job to the people, so you're not going to get voted in again. But secondly, because you want to restore trust, because as opening government says, and government side in general says, they want people to start going back to the banks and start trusting financial institutions again. So they need to make it seem like it was a clean job, like they took out the people that they needed to already, as opposed to needing to go after more and more people in the future. B, because going after banks and bankers is difficult. They have tons of money and capital, and you need to use huge amounts of resources as a prosecutor in order to go after them. And so it's much easier to go after things like low-level crime, which they factually do under our side of the house, and will do much more under their side of the house. C, everyone bets that they're not going to be the individuals that caused a crisis. As a result, you can do fraud all you want because the public doesn't care enough to push the prosecutor to use resources to actually go after and prosecute you. You only get prosecuted if a crisis is actually caused, but no one actually thinks that they're going to cause the crisis. See, because the problem, again, is complicated. We're talking about shadow bankers and silent problems. It's not clear whose fault what is, and therefore nobody thinks that they will be prosecuted. There is no deterrence. I want to just be clear then, prosecution is more likely under a regulatory framework because we assign responsibility more clearly. Bosses and traders can be held to clearer standards. Is this perfect? No, but that's why we don't rely on prosecution itself. We rely on regulations that can prevent a lot of these things from happening in the very first place. Okay, next I want to talk about why regulation is effective. For that, POI.
Your warrants for why prosecution is hard is exactly why no bankers will ever go to jail on your side. On our side, not only do we prosecute people very publicly, but we also get a huge amount of information via leverage and forced transparency so that we can do it in the future.
Actually, that's great. I forgot to respond to that. Yeah, that's a poor argument because you get information about people who work at the bank right now. You don't get information about people who will work at the bank in the future and commit fraud in the future. So presumably, if they just figure out a way to lie to people in some new manner, and they have tons of resources and ways to do this, they will never get prosecuted in the very first place. So yeah, all of your case fails, unfortunately. Okay, so regulation is effective. I want to be clear firstly on framing. Why was systematic risk a much greater risk than fraud? So it's not just fraud. Again, Michael works at MS, so like it's not just Goldman's back here. All right. This is the classic narrative that causes financial crises. The idea that we can grow quickly and break some things because we are not those bad apples. To be clear then, under their side of the house, there's a strong incentive for politicians to say, look, those were the bad apples. Those were the leaders that caused the problems. We got them out. You can now trust the industry. That's a problem because when people think that it was just an issue of bad apples, we think that you get much more unstable systems and you almost inevitably get financial crises. One, because this is endogenous, like 2008, there's endogenous problems. But two, because it amplifies the impacts of exogenous shocks. That is that the system is less resilient to anything happening from the outside, like for instance, COVID. But see, I also want to note, crucially, the public doesn't understand financial markets, so they can't track the pattern. We need to establish strong financial regulatory agencies because as they know under their side of the house, there are lots of new financial instruments popping up every day that can confuse people and can cause problems. And we need an adaptive regulatory agency that is given power in order to do that. Okay, what does that look like? I think one, this looks like a ban on prop trading. Why was this necessary? Prop trading creates a time mismatch between long dated assets, as in you get paid back over a long time, and short dated liabilities, as in people ask you for money tomorrow. The issue is that this creates a loss of confidence in the bank. If your risky investments go kaput, people's actual deposits are impaired. Why was it effective to regulate? One, because it's an empirical falsehood that the vast majority of banks didn't significantly scale back their prop trading operations. Banks don't really have AM divisions anymore. Devesh, it's lucky that you work at one that maybe does. Two, if there are loopholes, this is mitigation because it is costly. It is hard to get around those loopholes. You need to spend tons of resources. And the SEC can push back against them with new waves of regulation because the SEC actually exists now and was empowered given all the political capital we spent in 2008 and 2009. Two, capital requirements. Why was this necessary? Because we don't have enough liquidity when bank runs happen. Why was it effective? Because Trump's Dodd-Frank reform was partial but not complete. Capital requirements are still much more comprehensive under our side of the house. Three, regulations on derivatives, significantly scaling back large mortgage-backed securities, requirements on their underwriting and the quality of collateral had to be demonstrated, restrictions on their bundling. That looks like restrictions around their issuance and disclosure requirements, requirements about their tracking. Lehman literally didn't know where most of their loans were. That changed under our side of the house. This is the most important part of 2008. I think that crucially means you're much less likely to get the huge risks that they talked about under their side of the house. So again, it's not about little like individual bankers lying to individual people buying their loans. It is about the huge structural risk that we don't know where the loans are going. We don't know how they're bundling. We don't know how valuable they actually are. That we prevent under our side of the house. So the regulations are highly effective. But to be clear then, even if none of that is true, their prosecution is ineffective. It makes people more liable to a system that is likely to lie to them, that is likely to sell them on bad securities to say, we are not the bad apples, and therefore you can trust us. More people get duped on their side. That's an independent harm. Very happy to oppose.
Thank you very much for that speech. And it's time for the government whip to summarize the government bench of this debate.
POIs in chat, please. Okay, I'll start in 3, 2, 1. The question of whether or not regulation works is not a relevant question in the debate. We can agree with CO and say that large parts of Dodd-Frank are still intact and stress tests on mortgages still exist. The problem is that CO never engages with the normative question. They simply make the same assumption that OO did, which is that these regulations were a good idea in the first place, with literally no line of response in MO to all the analysis that Naomi gives in terms of why these things are more economically damaging, or the weighing about why growth matters more than recessions. The other thing that I want to note is that the lack of engagement on consolidation is particularly damaging, because we already explained in extension why a higher likelihood of banks consolidating due to the high costs of regulation increases the risks of economic crash, A, due to systematic risk that is not accounted for because regulatory lag is real. The more that banks invent new products, like a cool thing, right, is that collateralized debt obligations still exist. Banks still use them. There's huge loopholes in the regulations. CO never beats even OG on that analysis. And that ultimately ends up meaning that when you get more consolidation of banks and they continue to increase these harms, move into cryptocurrency, stablecoins, et cetera, that all those harms are entrenched. So CO can't even overcome opening government on that analysis. The second thing that I then want to address is the problem in the front half in terms of the absolute wash that systematic risk ends up being, which is only broken in Naomi's speech. The reason why this is incredibly important is that it's unclear whether or not it is an individual's or system's fault. Like, obviously we can argue on Gov that there's a principal agent problem in place, that individuals have large incentives to grab their golden parachutes and leave. We think on Gov that prosecutions will successfully increase the likelihood that literal fraud will not happen. And that is a benefit that OFF is less conclusively able to access because there's a government resource trade-off in terms of strengthening prosecution versus strengthening policy that is assumed by the debate. The second thing that I then want to address is why policies are not good at stopping systematic risk. The reason why is that most systematic risk is caused by the large firms at the top. It is not caused by the people who are caught in the crossfire of regulations, the regional and local banks that have been forced to close during the last secular bull cycle, and huge consolidation like the merger of Merrill Lynch and Bank America as a result of the high costs of regulatory compliance. But instead, it has been the invention of new financial instruments that stay above regulators, and as a result, systematic risk is not effectively kept to. The last thing that I then want to observe is that capital controls are not good at solving for systematic risk. A, because no engagement on bank runs from CO in terms of Naomi's analysis, that this doesn't really change consumer behavior on bank runs. But secondly, because the capital requirements change have been enough in terms of deterring investment, as in like worthy people who should get mortgages are not getting mortgages, but will not be enough in the case of a huge financial systematic crash, which would require monetary policy and all kinds of other government responses that come from the central bank or from fiscal stimulus, regardless of the outcomes on either side. Then the central question is whether or not it is good to have more risk leading to more growth in secular cycles. And the reason why I think that framing ends up being really important from Naomi is the key link, that regulations don't end up being effective against the people who are most likely to break them, but they do catch large numbers of economic growth in the crossfire. For most banks, the additional space that would have been created by the $200 million market cap stress test requirement, for example, or by the capital requirements are broadly not going to change risk. This is because there's a large amount of people in the times when there is economic growth who are able to successfully use investments. And most of these capital requirements are ultimately arbitrary due to the high level of conservatism inherent in stress tests or in the underwriting of mortgages. What it does end up meaning, though, is that it's just harder for people to get loans. The first people who begin to come out of the financial system are not the financialized people and banks who, as we pointed out in the POI, have a habit of literally hiring the regulators who write the Volcker rule to come work in-house and break the rules that they wrote themselves, and this is not illegal at all. And then the second thing that was important was just that most of the harm ends up being when you disaggregate investment banks and commercial banks, they now can cross-subsidize between the two branches less. They have higher stress tests in place for mortgages, which mean broadly poor people don't get access to loans. The importance of this frame, of course, is that low efficacy against true financial risk, low efficacy in terms of regulatory lag when they focus more on capital requirements, but the SEC has not regulated stablecoins effectively, is really bad because it misses the forest for the trees in terms of where the actual financial risk is, and instead ends up criminalizing and undermining the ability of normal people to access credit and financial access. The second thing that it does, though, and this is where Naomi adds a lot of stuff that I think is quite important, is that greater levels of growth, which happen as a result of the multiplier effect, mean that there actually is a built-in buttressing against the likelihood of recessions. Naomi pointed out that exogenous shocks do happen, and there are recessionary elements that do end up coming into the economy. But the financialization risk is not the main cause of the vast majority of recessions. It means we weigh all of the front half clash on stopping recessions and the CO analysis far less than we should weigh the additional benefits of getting more growth, which then means that the eventual impact of recession transactions is lower. Finally, I think that the important analysis on the individual incentives for banks was not responded to by CO. That is to say that the issue in 2008 was not that banks had long-run incentives to send themselves out of business or to cause contagion, but that particular individuals had wrong incentives, which a greater level of deterrence that OG already mechanized helps to solve for, and that Naomi adds in new mechanisms in terms of why banks don't have long-run incentives to take excessive risks. To the point where prosecutions solve for the principal agent problem, there is a slight margin to gov on the actual effectiveness in terms of stopping literal crimes, right? Like defrauding investors, like Tether taking all the money that was put in for NFTs and like investing it and not in stable US dollars. So that stuff is better covered in our world. And notably, the reason why fraud and actual crimes matter a lot in terms of the way we regulate finance is that these things happen during secular cycles. And they don't, they obviously happen in recessions too, but the point is they happen in both, meaning that we should weigh this more highly. I think the reason why this broadly weighs over opening government is that A, the political arguments they make are pretty speculative. It's really hard to tell whether or not financialization was the cause of Trump instead of like racism. And then second of all, the reason why this weighs over OO was that most of their arguments were premised on the idea that these regulations work, but our case just explains that these regulations were bad in the first place and should not have been implemented. And it would have been better to focus more resources on criminalizing the elements that were bad in terms of defrauding investors, in terms of taking on risk that was not adequately reported, than it would have been to put regulations in place to harm everyone. The last thing I want to note then is why consolidation effectively flips the remaining aspects of the opposition case. The mechanisms that Naomi gives in terms of consolidation increase risk and consolidation, not just for banks, but for everyone. That is to say, small businesses and poor people not being able to access home loans for mortgages or starting small businesses means that big businesses still do access these loans, right? Because now banks are not connected to their investment branch, they have less money, their requirements for mortgages are stricter. This ends up meaning that you get corporate consolidation as well, greater levels of inequality, because wealthier people are still able to access these things, but poorer people are cut out as a result of stricter regulation. That means that the harms in terms of corporate consolidation, inequality on opening government and on CO are mechanized by this claim that bank concentration leads to corporate concentration as well. Then the observation that I just want to make is that if you don't believe in the top half that the chicken or egg problem is resolved, which it was obviously not in terms of whether individuals or systems were more culpable, what you ought to care about is whether or not the regulations themselves actually solve the problem for the privileged few while undermining financial success for the many we are so proud to propose.
Thank you very much to the government whip. Now I would like to ask for the stream to get off, and I would like to invite after that